Hello and welcome back to Simple Money Podcast, Canada's own personal finance podcast presented in short and informative episodes. I'm your host, Matthew Seawick, also known as the Friendly Financial Coach. And today we're going to continue our conversation about inflation and what types of investments historically have been able to protect against it. So just this last week, another inflation announcement was made in Canada. This time, the annual inflation rate was 3.6%. And when we do our research on what's causing this gain, what we see is the largest increases are coming from energy costs, shelter, and vehicles. The background of these increases is actually pretty cool. The rise in vehicle prices is tied to demand increases and the shortage of semiconductor chips. These chips are used in all aspects of vehicles, and the lack of their supply is really starting to push up the price of vehicles. I don't know if anyone listens to Planet Money, but they actually had a fantastic episode on why the price of vehicles in the United States was increasing so much. And they covered all the different aspects of the car market. If you're interested in the episode, which I highly recommend, I will include it in the show notes. So, overall, Statistics Canada isn't really too concerned about these inflation numbers, as these price increases are being compared to pandemic prices that were much lower than normal. They also pointed out that many of the current prices are still less than pre pandemic levels. So, what we see is that the source of this inflation has really been twofold. We see an increased demand by consumers as we emerge from the COVID-19 health crisis. And on the other hand, we have massive supply disruptions of raw materials that occurred during the pandemic. These effects are pushing up the prices. And the story so far is that we still really don't know if these inflationary effects are going to become ingrained or are just transitory. Hopefully the latter, but only time will tell. And it is important to keep track of what's happening with the interest rates, inflation, and all that fun stuff. So, to understand the impact of inflation on our investments and other forms of wealth, it's important for us to first understand the concept of real rates. Generally, when we see an annual rate on holdings, these are called nominal interest rates. The rate that is going to be paid out or the expected rate that we think we're probably going to receive. Now, because inflation reduces the value of money over time, we could actually adjust this interest rate, the nominal rate, to show the effects of inflation. And this is called the real rate. So this is what you're paid post expected inflation. Now, there are a couple ways to calculate this, but the easiest way is to just subtract expected inflation from the nominal rate on the investment or savings account that you're looking at. A more complicated method is called the Fisher equation. And I'm not really going to talk about that. If you're interested, you could easily Google it. But that is a more exact way to calculate inflation's effects on holdings. And the ultimate goal is to have holdings with a positive real rate. If this does not happen, then the value of your wealth is decreasing over time. And obviously, the larger the negative rate, the larger that your wealth is decreasing in value. So, for example, a savings account would have a real rate of negative 2% if the nominal rate is 1.25% and expected inflation is 3.25%. I'm not going to talk about it here, but taxes would further reduce your returns as well. And something important to point out is that when you are taking steps to protect yourself from inflation, it may not make sense for you. This is really one variable in a complex decision making process. Many of the inflation hedging methods use investments that have greater risk involved, which may not be suitable for all financial goals or people. So before you jump into any products, it's important to make sure that it works for you. And it's also a good idea to speak to a financial professional. So one of the most common ways to hedge against inflation is through equity, either directly with stocks or through a fund like an exchange traded fund or low fee mutual fund. Historically, the nominal returns on stocks have outpaced inflation. The reason for this is that companies are also affected by inflation and will make adjustments to avoid it. This adjustment is usually done by increasing prices to pass along the costs to clients. And the increased expenses for businesses usually come through the inputs, through things like raw materials, supply of goods, and also labor. These essentially make it more expensive for them to produce their product. And in many cases, as mentioned, they'll pass this on to customers. And we're already starting to see this happen too. Companies like Coca-Cola and Whirlpool have already started to plan to increase the costs of their goods. So these increased prices really allow a company to maintain their profitability. Now, the interesting thing is that there can be a point where companies cannot pass price changes to customers anymore, which can then reduce profitability and negatively affect stocks. Now, certain industries also have advantages over others. For example, banks, healthcare, food, and others are insulated against inflation more than other industries. It's also important to point out that growth-based equity can perform better than dividend-paying stocks, as dividends can become less attractive when rates on other investments become more competitive. So other common investments to hedge against inflation are precious metals and commodities. Gold and silver are historic hedges against inflation and have been the typical go-to during past periods of inflation. The most common way to invest in these holdings is either through buying the physical investment grade precious metal itself or buying an investment that holds these. Very often you could actually go to a financial institution and buy precious metals from them, and you'll get a certificate that essentially, guarantees that this is investment grade precious metal. It's important to point out that precious metals and commodities are very, very volatile. To give you a bit of an example, the price of gold skyrocketed during the years of the Great Recession due to inflation concerns from quantitative easing. And it wasn't until recently where the price of gold surpassed its previous high, which is more than 10 years later. Another historic way to hedge against inflation is through property. The way to do this is to have ownership of an existing property or by investing in a fund that invests in real estate, such as a REIT. Now, to add a couple dashes of realism, buying property is exceedingly difficult to do in Canada right now, and you have to prepare for all of the additional expenses and responsibilities that come along with the process. And that's where many investors will turn to REITs. Essentially, you buy into a fund that has ownership of a whole large pool of investments, and you buy a fraction of that. So it's a much easier way to invest in real estate. So another question that comes up about real estate is whether or not it's a good idea to invest in commercial real estate, as we still don't know if the demand for these properties will be sustained after things begin to normalize. Many businesses will likely stick with working from home structures in some capacity, but the full impact at this time is unknown. Now, the final category that may possibly hedge against inflation are cryptocurrencies. There are quite a few different crypto products out there, but the largest and most well known is Bitcoin. Proponents of crypto believe that it could be the new hedge against inflation, essentially taking gold's mantle. However, the truth is that we just don't have enough historic information on whether or not this will transpire. What we do see, or what we have been seeing, is that crypto is very volatile and the value has been dropping while inflation concerns have been increasing, which is obviously not a good sign. Now, there probably are some inflation hedging aspects to crypto, but one worry is that this effect may be being drowned out by other market effects. Either way, this is definitely one to watch to see how it acts in the future. Now, you're probably wondering what type of investments you should avoid. And traditionally, one of the most sensitive investments to inflation are bonds, with an emphasis on longer term periods. The way that bond prices move can easily confuse new investors, but the basic idea is this. Most bonds have set interest rates that are part of the contract. And if all of a sudden, if inflation or expected inflation increases, then new bond issues will have to come with higher interest rates to remain relevant. This then means that bonds with the lower interest rate are not as attractive as the higher rate bond, and to compensate for this, the price goes down for the one with the lower rate. And the opposite is also true. Bond prices will usually go up as inflation decreases. Now, not all bonds are equal. Historically, long-term bonds are more sensitive to rising rates than short-term bonds. There are even some bonds that have variable interest rates that change with market rates. So moving on, another investment in Canada that is really affected by inflation are GICs, or Guaranteed Investment Certificates. The problem here is that most GICs have fixed rate periods that can last up to 5 years. Those that hold their funds here are very susceptible to inflation, as their holdings can easily be stuck for long periods of time. And this really translates into an individual possibly receiving a negative real rate. Now, holders can typically break their GIC contracts, but there may be negative consequences from doing that. In reality, most issued GICs have low rates to start with and usually already had a negative real return. So what we're seeing now with the possibility of more prolonged inflation is that this can further aggravate that issue. And the final holding category that we're going to cover are savings accounts and checking accounts. Checking accounts typically pay next to zero in interest. It's pretty sad, actually. And savings accounts can pay around 1.25% if you shop around. And you can see how the negative real rate here can be pretty drastic. Now, it's very, very important to point out that it's recommended to keep funds in a high interest savings account in some cases. For example, if you want to put your money in an emergency fund. Other situations can be if you require extra liquidity. Maybe you've just started a small business, or if you have a financial goal that is quickly coming up. But never, ever keep large amounts of savings in a checking account. It's an easy fix, and you could easily earn some extra interest elsewhere. So that's it for today's episode. I hope that you enjoyed it. This was the second part of our inflation series. And as always, if you have any questions, please contact me at info@ffcoach.ca. And if you're enjoying the show, please consider sharing with a friend, family member, or anyone else that you want to share the material with. So take care, be safe, and talk to you soon.